This is the Traders Exclusive Live Trader Showcase for March 2024. This is a quarterly event where we feature expert traders to bring you training and insights from 20 different expert traders. So please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not necessarily indicative of future results. So I want to thank you all for being with us again. I'd like to introduce Lawrence G. McMillan here of the Option Strategist. He's going to talk to us about option-oriented indicators and what they're saying about the stock market.
All right, thanks. So we're going to talk about the market, what the option indicators are saying, and what are the indicators that we watch. Just as a little bit of background, in case you're not familiar with us, I ran a prop desk on Wall Street for a while, and then started this company originally as a derivatives research firm. We were making recommendations, selling data, that sort of thing. But in the financial crisis of 2008, we had some pretty good recommendations. So people asked us to start managing money. So we managed both as a CTA in the future side and an RIA on the stock side. And we're basically just use one classic option strategy, although we can, do certain things for individual accounts. And then we also have an education section, so seminars like this or mentoring, that sort of thing. So I'm going to come back to this later, but if you go to this link right here, optionstrategist.com/traders exclusive, you can download the PDFs of this webinar, so you'll be able to have those. There's a grayscale and a color. All right, so let's get started. There's four main indicators that I look at. Obviously, the S&P 500 is the number one thing. If your indicators are leaning one way and the market's going the other, you really want to reevaluate your indicators. But typically we're using the chart of the S&P 500 to give us a core position, and then we'll move around that with other indicators such as equity-only put-call ratios. That's one we pay a lot of attention to. Market breadth, we have an option-oriented way of looking at that, and then VIX and the various volatility derivatives and indices. So a very important rule is that oversold does not mean buy. But that means that if the market is going down very heavily, it can get oversold. It can stay that way for a long time. So in many of our indicators, we have very specific ways that they generate buy signals, and they'll get oversold, but that doesn't mean we're going to buy. And a companion to that is overbought does not mean sell. So that's more apropos to today's market. We do have some overbought indicators, but we don't really have any confirmed sell signals at this time. So here's a long-term chart of S&P, just kind of throwing that up there so we get a little perspective. We had that bear market in 2022. It sort of seems forgotten now, but it was out there for a while, and the market declined 27% during that bear market. Then we launched into this bull market. It was, well underway, but we had a 10% correction last October, which turned out to be a pretty healthy thing for the market, because since then we've been blasting off to the upside. We're up 1,100 points since last October in the S&P, which is a lot, but the market is just, it does what it wants to do. So I can't just say that it's overbought and or 1,100 points is too much or any of that sort of thing. Here's a close-up chart or one-year chart, and you can see a little bit more definition here. We had some support, and we still do have support at 50.50, where the market traded in late February and early March. Then in the second part of March, or the rest of March. It's been trading up to about 51.80, but now yesterday it broke out on the upside and it's adding to those gains today. So this upside breakout is a strong one, especially since we did all that work in this area right here. So if you want to have just kind of a demarcation line, is 50-50 would be it. I mean, if for somehow or other 50-50 gives way, then that would be a fairly big negative, although the long-term support is down here at 4,800. But that's a long ways from here, so you wouldn't want to wait 400 points in the S&P before you took some action. The little purple circles there are gaps. Used to be gaps filled on the S&P chart almost immediately. Obviously, those two are certainly the one from last November has been there for quite a while, and the one from last month is now looking like it might be there for a while as well. So just to summarize this up, the S&P has been making this series of new all-time highs. It's actually done that on 19 different trading days since the first one of January 19th of this year. That's when it broke out over the 2022 highs, January 2022. That area I refer to, the 50-50 to 51-80 area, is very strong support. And, we're not really looking for those gaps to be filled. So basically, we're holding a core bullish position because that's a bullish S&P chart. It's got support behind it. And it really hasn't even pulled back and touched the or closed below the 20-day moving average really since January. So this is another thing we do with the S&P chart is we draw what I call modified Bollinger Bands on them. We use those for trading signals. So when John Bollinger invented Bollinger Bands, he used as the definition of realized volatility, he used the standard deviation of closing prices, which seems reasonable. But in the math world, Black-Scholes model, for example, they use the standard deviation of daily price changes, percentage price changes. It's a slightly different definition. And since our realized volatilities need to be in line with the implied volatilities coming out of the Black-Scholes or other option models, we need to use this definition. So that's what we use. And we draw the Bollinger Bands around it. And if the market moves outside the 4 standard deviation band and then comes back in, that's a signal. But we do require a secondary confirmation of that signal to give us what we call McMillan volatility band buy and sell signals. So here's the current chart going back about a year, same chart we just had up there. But now these buys and sells are modified Bollinger Band, or actually McMillan volatility band signals. So here's a buy signal down here. You can see this bottom line is -4 standard deviations, and the one just inside it is -3. So you move outside, then inside, that's a buy signal, and we're looking for it to move to the other extreme, which it finally did here. This sell signal, the blue letters are unsuccessful signals. This one came above the +4 signal, went inside, but then went back outside again. Anyway, we had a nice sell signal there, good buy signal at the bottom, and we really haven't had only just one confirmed signal on the way up, and it was a sell that was quickly stopped out. We got in here, got out there, and meanwhile, we're just waiting now to see if the market can get above the +4 sigma band, which is up here right now, 52.75 or so, but you can see it's rising, so the market's going to have to kind of accelerate to get above it. And then even if it does, it's not guaranteed that a sell signal would set up. I mean, it will, that will be the first step in really what's a 3-step process to try to set up a sell signal. So this indicator is right now neutral. We don't have a signal working. This methodology can be, that's just more or less what I was just saying. But this methodology can be used to trade really any chart, stocks, indices, futures, or what have you. So we have a service actually that will email you signals daily on where the various buy and sell signals are occurring. You can look at charts on TradingView where it shows this indicator. And you can see here, this is the one I just had up there. That's that sell signal that was unsuccessful. These buy signals down here. You can see they pretty much clearly show up on the chart, and they come up as soon as they're registered. So if you're interested, that's a service that can be purchased through our website. Well, let's move on to the next topic, which is put-call ratios. Put-call ratios were invented as an indicator by Marty Zweig back in the 1950s. And in those days, he was getting the option volume out of the ads run by the broker-dealers in Sunday's Barron's. There were like 6 or 8 dealers. So he'd add up the puts and calls that they claimed people traded. And he noticed that when there was a lot of call buying going on, mostly in those days it was buying of the options. He was when he noticed that there was a lot of call buying going on, pretty soon the market went down, and vice versa. When there was a lot of put buying, pretty soon the market went up. So he realized it was a contra indicator, and he based a pretty successful indicator on that. Now we're much more sophisticated today, but we still use the same essential methodology. So to predict a broad stock market, we use the equity-only put-call ratio, which is all stock options that trade. So there's millions of these that trade every day. And this is Marty's theory: too much put buying is bullish for the market, too much call buying is bearish for the market. But we need to refine this. Just saying too much is too general. So I'll show you how we do refining. We publish about 16 or 1700 put-call ratio charts on our website every day in a low-cost subscriber area called the Strategy Zone. And on those charts, we show both the stock price and the put-call ratio because you need to have it for perspective. Ideally, they would be inversely related to each other, pretty much like this. When we're talking about, let's just say IBM, if we summed up all the puts that we're trading that day and then divided that by the sum of all the calls that we're trading, that's the put-call ratio. So you can see that if people are buying a lot of puts, it's going to make the ratio go higher. And when would that happen? Well, that's when the stock is going lower. So that would be like in this case, stock's going lower, people are buying puts more and more heavily as the stock drops, and the put-call ratio goes higher. Eventually, the put-call ratio forms a local maximum right in here, and a local maximum is a buy signal for the stock. So let's say this is correct, and now the stock starts to go up. As the stock starts to go up, people start to buy calls. That forces the ratio down. Again, look at the fraction on the left here. When the denominator of a fraction increases, the fraction drops in value. So move over to the left side of the chart. People are still buying calls, forcing, as the stock is going up and the ratio is going lower. Eventually, you get to a local minimum on the put-call ratio chart, and that's a sell signal for the stock. So that's ideally, if you're looking at a put-call ratio chart, you should look at both these things, and they should have a good relationship to each other. Not perfect necessarily, but a good relationship. And I'll show you some charts in a minute. But for the broad market, the reason we use the S&P 500 predictor as the equity-only put-call ratio is this. On the top there, this is not a current chart, by the way. On the top is the S&P 500. On the bottom is the equity-only put-call ratio. So you can see the inverse symmetry that exists there most of the time, and that's what we're looking for. So local maximum, local minimum, etc., work out pretty well. Here's the current chart of the standard put-call ratio going back about a year. So let's just say right in here, you can see we had the local maximum, and that's a buy signal. It was just a touch early, but then the market did take off, and this signal stayed in effect all the way down to here. Well, we got a local minimum there at the beginning of January. Now, I put a blue S for sell there because it really didn't work out unless you were selling the Russell 2000 or something like that. But the one last summer, preceding that 10% market correction that we talked about earlier, that local minimum worked out quite well. This one right here. And so that's what we're looking for right now. Now, you can see on the far side of the chart there, I have a green S because it looks like a local minimum has formed. The problem is that it's just sort of drifting sideways. It's not really racing upwards. In a real sell signal, it would start to accelerate upwards like this. And if it does, then I would say, yeah, that's a confirmed sell signal. But right now, it's just sort of like in an extremely overbought state. At the bottom of this chart, the market is overbought. At the higher points, it's oversold. So we're overbought, that's for sure. I'm not so convinced that that's really the sell signal that we're looking for. And I'll show you the other chart in a minute, which would confirm my opinion. So as computers came along, we were able to calculate what's called the weighted or dollar weighted put call ratio. We calculate it like this. At the end of every day, we take the option's closing price and we multiply that times the volume that traded in that option today, that day, and call it the dollar volume. Now you could do this on a tick by tick basis. That's kind of expensive data and it's kind of eats up a lot of computer power. It wasn't giving us any better results than doing it this way. So we make that calculation, again, let's say in IBM, make that calculation for every option. And then we sum up all the put calculations. Separately, we sum up the call, divide the two, and that's your dollar weighted put call ratio. So now we're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion, which is significantly different than just the volume of the options in question. It turns out that the put call ratio signals from this methodology occurred about the same spot as the other one, except they're more extreme. So here's the current chart. You can see again the buy signal last November. Now this one's hit the bottom pretty much more correctly, although I will have to say we weren't really convinced it was a buy signal till about right there. We have a computer analysis program that looks at these charts, treats them sort of like a chess tree, like you're playing forward on the chess tree, what data is coming off the 21-day moving average, what data is coming on, and can give us an opinion. So we get down here, for example, like right now you can see this is that lower, a local minimum again, which could be a sell signal. I put a question mark here because you can see this one already kind of started to drip back down again. And in any case, it doesn't look like this, which is what a real sell signal should look like. So I'm just holding off on that. I'm not really anxious to jump in front of this freight train of a bull market, and I want to have good confirmed signals. When we do we have plenty of other indicators, anyways. But this one right now, again, overbought, definitely overbought. Bottom of the chart, lowest it's been since the end of that previous bull market, right before we went into the bear market in 2022. So it's in the area where a sell signal should occur, but this kind of drifting slowly sideways thing is what it also sort of did right here in January. That's just not a really confirmed sell signal, in my opinion. So that sort of says the same thing. By the way, if you do calculate these ratios at home, sometimes people will use the equity-only put-call ratio from the SIBO. And that's data they publish every day. But there has been a form of arbitrage going on for really over a year. And it has to do with the fact when very liquid, high-priced stocks are well below their previous highs, so that might say Tesla, there's a form of arbitrage that goes on there where option volume in the puts gets very heavy, has nothing to do with what we're talking about here about contrary opinion or anything, but it does increase the volume of the puts without increasing the volume of the calls. So you have to be careful of that. We read that stuff out when we're drawing the charts I was just showing you, because it's pretty obvious when you look at it. But if you're just taking you'll have to look at the individual stocks. But when you just take the data off the website, you could, be running into a problem. So if any of you are using a CBOE put-call ratio, just be a little careful. And invariably, this happens on Wednesday. So yesterday, even though the market was breaking out to a new all-time high, the put-call ratio on the CBO increased. A little strange, and it is due in part to that arbitrage. So what do we buy when we're trading these S&P signals, whether they're Bollinger Bands or put-call ratios. If we're trading the broad S&P, I will trade SPY options. Now, I like to trade when I'm speculating. I like to buy an option and it has a fairly high delta. So, because I'm in the business of predicting where the underlying is going, the option is just there to give me some leverage, give me limited risk, etc. I'm not trying to, win the lottery with the option. So I want the option to move with the underlying if I'm right about the underlying. So the delta of a call option, for example, ranges between 0 and 1. 0 means the call doesn't move at all when the stock moves. 1 means it moves exactly with the stock. Well, you probably don't need 1, but 0 is very bad. I don't want to buy, give a buy signal on, let's say, S&P and therefore SPY, and see it go up and have my option lose money. So we typically buy an in-the-money option with a delta of about 0.70 or higher, and in SPY, that's 1 or 2 strikes in the money. If I'm going out farther, like some of those put-call ratio signals could be like 4 months out, then I'll buy an at the money. But even that has a delta of like 0.55 a call, and so that would move with the stock, and the more the stock moves, the higher the delta gets. So on TV, you'll often see they're recommending option spreads, even when they're speculating, and they usually say, well, it saves you money, it's less risk, blah blah blah. But in reality, it's a poor strategy unless the options are expensive. So we publish free volatility data on our website every Saturday, and you can find that by just going to to our website. And if you want it every day, you can subscribe and get the same data daily. But so you can tell whether options are expensive or not. You can see the implied volatility percentile, with 100 being extremely expensive, 0 being very cheap. And so unless options are expensive, there's no reason to be cutting off your profit potential. The spread that I'm talking about here, and that they're often always talking about as well, is this. So when you get bullish on something, you buy a call at this strike, and then they're suggesting that you also sell a call at this higher strike. So between the two, you make money, but once you get to the higher strike, that cuts off your profit potential. Well, I don't know about you, but my trading in the long run I've had some huge winning trades that without those, my rate of return would be completely destroyed. And so I don't want to cut off my profit potential. In fact, I want it to look like this. The red line is owning a call, and you can see that it has unlimited profit potential up here. Cutting off my profit potential there, can be a problem. And that their theory that there's less risk is completely wrong. Both of these positions have 100% risk of the money that you put up. So if you're buying a bull spread, your broker will require you to put up the price of the spread, and you could lose that all. Or if you're buying a call, it requires you to put up the price of the call, and you could lose that all. Now, they're not the same price, and so you might, instead of buying, let's say, 5 spreads, maybe you buy 4 calls. But if you do that, you have this unlimited profitability to the upside, and so that's what I'm really trying to attain. Now, sometimes, as I said, even when the options are expensive, you would do a spread. So how can you mitigate the negative aspects of the spread if the stock goes up to your higher strike? Well, first of all, you can spread the 2 strikes apart pretty far. So that will help gain, distance in the middle there. And then secondly, if you get to the higher strike, roll your whole spread up, because it's just about out of gas at that point. So, for example, right now, if we're trading options expiring earlier than April 30th, I'm not spreading. But VIX is a kind of weird animal, and so the longer-term options actually have a higher implied volatility in many cases. And so, if we're expiring after April 50th, if I'm doing a call spread, I'll spread the 2 strikes about 20 points apart. Puts more like 25 or 30 points, because the puts are more expensive than calls on a relative basis on really all the indices. So when I say roll if the short strike is hit, this is what I mean. Suppose you put on a spread today and the S&P's at 520 when you put it on, yeah, and you do 20 points wide on the spread. So you're buying the April 520, you're selling the April 540, and you're fortunate enough to see the stock rise or SPY rise to 540. But now, your spread is like this. This is just 540. You're just about out of gas. Yeah, there'll be a little bit left in the profit potential, but not a lot. So what we do when we have these on is we sell that spread that we own. We sell this spread up here that we bought, take a profit, and buy a new spread, also 20 points apart. But now you have a chance to make that spread widen out. So those two things will help, negate some of the poor ramifications of owning the bull spread in a market that's roaring away to your upside. Let's take a look at some individual put-call ratio charts too. Now, in the individual put-call on stocks and futures indices, well, not indices so much, but stocks and futures, we only use the extreme local maximum and local minimum. So this chart, for example, Mohawk, you can see that in the middle here, that's a buy signal, and so is that. It's in terms of the fact that it's a local maximum. But we're not trading anything in the middle. We're just trading what's happening on the edges. So this was a very low put-call ratio at the time. You'd have to be able to look back and see how it compares to the previous year or so. But the stock did go down after that one. So this one too. Here the stock went down farther after that one. And we did have this local maximum there. That didn't really pan out. But then this one did. So now we're over here. It attempted to make a local minimum here, didn't really work out, but now we've formed another local minimum, and the stock has broken support right here. It broke down through some support. So to me, those two things together is a sell signal. So we just bought puts on Mohawk. This is a gold, Barrick gold, not gold itself. And you can see that it's had some pretty decent signals in the past, both buy and sell. And so when I'm talking about the chart should work for both when you're looking at the stock and the put-call ratio, that you should be having some decent signals here only from the extremes. And so we just had a buy signal there, the stock's starting to move higher over the last week or so. Here's another one, Baker Hughes. This signal was a little bit older, but it's one that we're still in. By the way, once I'm in these things, I might roll the options up and take a partial profit or something like that. But the signal itself lasts until the put-call ratio rolls over and starts to go back the other way. So this is still on a buy signal, regardless of what the stock is doing. That's how I treat these put-call ratio buy and sell signals. This is another one. We just got into this one. A sell signal on CSX Corporate just broke down below 37.50, I believe the other day, maybe the end of last week. And that gave us the breakdown we were looking for to go with this extremely low reading. In fact, the lowest this put-call ratio has been on this chart. Right here. So that reading is about, like, let's say 35. What 35 means, this is a weighted put-call ratio. What 35 means is that $35 are being spent on puts for every $100 being spent on calls. So again, local minimum, stock breaking support, buy puts. Now we can do this with futures options too. So this is cattle, and on the bottom is the put-call ratio using the cattle futures options that trade on the Chicago Mercantile Exchange. Now, there is no corresponding ETF on the stock side of the ledger for cattle. There used to be something called meat. Way back, there was something called beef, but those have been delisted. So this buy signal, which has worked out pretty well, you would have to trade the futures options. You really don't have any other choice than to actually open a futures account and trade the futures options on the Merc. However, here's a new signal we just had. This is a current signal now in corn. And corn does have an ETF that's CORN, surprisingly. And so this you can buy options on corn, CORN. They trade. So those you can do if you just have a regular stock option account. You don't need a futures account to trade those, even though you're basing your analysis on the futures options that are trading on the Chicago Board of Trade. Anyway, we just got a buy signal there, and so we're buying corn. Over the years, it's worked out pretty well. That one buy signal last September didn't. It was just kind of flat for a long time, but never really gained any traction. So let's move on to the third thing that I look at is breadth. So market breadth is just advances minus declines, simplistically stated anyways. And there's two things we can do with that. We can keep a cumulative total, just every day we take advances minus declines and then just keep a running total, or we can compute an oscillator. So we do both, but the way we calculate our oscillator is this. Today's oscillator value equals 90% of yesterday's oscillator value plus 10% of today's advances minus declines. Now we actually look at two data sets here though. First of all, New York Stock Exchange advances and declines is really what everybody looks at. And of course, we look at that too. But there are things on the New York Stock Exchange that are not stocks, and they can at times, especially if interest rates are moving, any of the interest rate related instruments that are listed there will distort the advanced decline numbers. So we look for a stocks only one. And I know the New York Stock Exchange publishes what they call operating company data, but we had a better data set for this. This is all stocks that have listed options on them. There's over 6,000 of those now. Actually, it's starting to approach 7,000. And so we just can look at this daily, and we have big caps, small caps, over the counter. Just a broad spectrum of stocks. I think it's a more reliable data set. Anyway, here's the oscillator for the stocks only going back to 2013. That's a long ways, of course. And the market mostly has been going up since 2013. It went up really from 2013 all the way to 2021. So the green areas here are oversold. The market was not going down much in that period of time, and we didn't get too oversold. Yes, we did a couple of times. Yes, right there. That was that December of 2018. This was the pandemic. But by and large, the market was mostly going up over that period of time. Then we get to 2022, and we go into the first real bear market in that time frame that lasted any length of time. You can see how much more green territory showed up. And even then, the little 10% correction last October gave us this whole bunch of oversold there too. So remember at the beginning, I said oversold does not mean buy. So we don't actually buy until it stops being oversold. So there was a buy signal there and there. And then the opposite, of course, is up here in the red areas where it gets overbought. And this actually resulted in the most extremely overbought condition in history. That was just earlier this year. But now we've backed off of that. But we're right here right now. So we're just a little bit overbought. And we actually tried to generate a sell signal last week. That failed. But I would expect with a market that's made 19 new all-time highs this year for the oscillator to be up in this area, or something like these where it's really rocking to the upside. It's not. So breadth has been a problem for this market. And it's kind of hangs in there, but it's not really, robust like you'd like to see it. So we tried to, try to use it for a sell signal last week. That didn't work out. But if we get another sell signal from breadth, we'll definitely be trading it. There's also something that we follow called cumulative volume breadth. This is where you look at the volume on advancing stocks minus the volume on declining stocks every day, and then you keep a running total. So we call that CVB. CVB is a great indicator, especially at market highs, looking for divergences between, the market doing really well and stocks not doing so well. Well, as it turns out, CVB is making new highs right along with the S&P right now. 9 times in the last few weeks, this has made a new all-time high, just as S&P has made a new all-time high. So, everything is good. There's no divergence here, and so this indicator would not be in play as a sell signal at this time. Another thing we look at is just new highs versus new lows. We look at 3 data sets: New York Stock Exchange, stocks only data, and then NASDAQ only. But their signal is actually based on the New York Stock Exchange data. And we had a buy in December last year. It exited in January, and then just a short time later jumped right back in. So this has been on a buy signal since January, still is, and it won't be stopped out until new lows outnumber new highs for 2 days in a row. So you can see that's what happened last January, but since then that hasn't happened, and hasn't happened yet. So this indicator is strongly bullish, and it's been one of our better longer-term indicators in the last several years. Well, let's move on to VIX volatility, all of that complex. So when we look at the chart of VIX, there's 2 things that are really quite important. One is the trend of VIX. The market should be moving opposite to the trend of VIX. And number 2 are spike peak buy signals in VIX. When VIX shoots up, it comes right back down again. It's usually an indication that people panicked and now they're getting back on the long side. So here's the current chart of VIX, and those Bs there are the spike peak buy signals. Again, the red ones are successes. The blue one is a loss. We have a trading system we build around this, so it's very specific. And the orange ones, when we have a buy signal, it lasts for a month. So an orange one means that we got a second buy signal within a month of the first one. We don't trade that second one. So we're just trading the first one. But it's been good. This over the years have been one of our better indicators, or probably even our best indicator. And if you look at the Option Strategist newsletter, we have the long-term track record of this, the signals on this, and they've been, just very, very successful over the years. So just currently, there's no buy signal. I'm sorry, let's back this up. The last buy signal we had there was in February, and the 30 days or the month has expired. So we just got out of that one the other day, and right now then there's no spike peak buy signal in play, and there's no trend in the VIX chart either right now. It's just moving sideways, bouncing around. It's 200-day moving average, but it is low. VIX is low. And so as long as VIX stays low, that's fine for stocks. People get all upset and say, oh, VIX is so low, that's a problem for the market. It's only a problem when VIX stops being low. So it's overbought right now. I would say that low VIX tells you the market's overbought. But again, overbought does not mean sell. So we're not going to panic and do anything silly until VIX actually starts to rise. Now, you can't trade VIX, but you can trade VIX futures and VIX options. And so the futures can give us some information as well. So typically, if we look at the price of the futures, they'll slope upwards like this. That's bullish. That's a bull market. That's a normal stock market. However, sometimes the VIX futures will slope downwards like this, and that's very bearish. The last time it happened to any great extent was March of 2020. You can make a lot of money when that happens with a specific strategy that we utilize and did utilize, and the same thing appeared in the 2008 financial crisis, but you don't really want to see that happen because it's really very bad for the stocks in general. Now, here's the current term structure. April VIX futures just became the front month yesterday, so they're trading it. They closed last night. These are prices as of last night. They closed at 1456. VIX closed at 1304. So 1456 minus 1304 is plus 152, and that's the premium. So if you look at the futures, you can see that For the most part, they're sloping upwards. Each one is higher priced than the one before it, except this one. I'll get to that in a minute. And so they all have this premium on them. And so when the futures are sloping upwards, the term structure is sloping upwards, and there's premium to VIX, everything is wonderful. That's bullish for stocks. And so this is a bullish data set. The October thing there is, of course, the election. And even though they say October futures, they're based on options expiring in the third week of November, third Friday of November. So that's after the election. So when a volatile event is about to occur, you see this all the time with earnings reports in stocks. The options that expire right after that event are the most expensive, and then after that they taper off in price. But right now, people are paying up for these November options expiring after the election. I guess figuring that they're going to hold them that long. I don't know. That's that's not a strategy I would be using, but obviously it's happening, and people are paying up for these October options. You can see for these October futures, which are related to November S&P options, and then the month after it goes back down again. So, as we get closer to this time frame, we'll probably be trying to do some calendar spreads or something like that to take advantage of what appears to be an anomaly in the term structure, this bubble in the term structure. But right now, we're just observing it. Now, you can get the futures prices off the CBOE's website, CBOE's futures website, or there's a kind of poor man's version, I call it, where you can look at the volatility indices that the CBOE publishes. There are 6 of them. There's a 1-day index, which helps if you're trading these 0-day expiration options. There's a 9-day index. There's VIX, which is 30 days. Then there's a 3-month, 6-month, and 1 year. They used to have different symbols, but now they kind of uniformly to do this by date. And here's how those closed last night. You can see the term structure just slopes right upwards there, perfectly upwards. And that's all good. And that's also bullish for stocks. So, all of this construct, I call it, which is the term structure, the premium, etc., is all bullish for stocks right now. What we do pay attention to is the front month of VIX future, which is now April, in comparison to the second month, May. If April rises above May, then you have a problem. You could have a problem. So, especially if it rises significantly above May. And, it didn't really happen in the bear market of 2002 because that was a calm decline. It wasn't a crash. But during a crash, that would invert. Anyway, if you see that inversion, you need to take immediate defensive action because it was a good warning sign in February of 2018 when the market got creamed, and it was also a good warning sign in February of 2020, right before the pandemic sell-off. So people are always asking, what's wrong with VIX? Why isn't VIX higher? Why didn't VIX go up during the bear market in 2022? It turns out, I'm going to show you just a couple of charts here to answer that question. There's nothing wrong with VIX, by the way. VIX adheres to the historical volatility. So VIX is a forward-looking thing. It's a 30-day implied volatility. It's a forward-looking where volatility is going to be over 30 days. Remember, we just saw was the 30-day index. If we compare to 20-day historical, that's 30 calendar days, by the way. If we compare to a historical 20-day volatility, that's about a month. So one's looking a month forward. The other is what happened in the last month, HV20, historical volatility 20. And they are surprisingly the same. Now, so the chart on the bottom there that goes back all the way to 1984, the pink line, that's your historical volatility. The yellow area, that's VIX. You can see that tracks very well. VIX is a little bit higher because there's some premium built in for the uncertainty of what's going to happen in 30 days, but it's not going to get way away from VIX. So here is that bear market of 2022, and you can see that here the market went down 27%, but VIX really didn't go up much. VIX is again the yellow line here. And the reason it didn't is because realized volatility didn't go up that much. So you had a bear market. Realized volatility got up to about 28%, maybe it was the highest there. Not like in a crash where, the pandemic, both realized volatility and VIX got up towards 90%. So a crash is one thing. A bear market is a totally different animal. Bear markets don't necessarily have a lot of high volatility until, so often in the end, not this one, but others have almost crashed at the end, and that has created some volatility. So where are we right now? Slightly different format to this chart, but the S&P is on the bottom, and the historical volatility is right here. We saw in the VIX chart before, the VIX is just bumping along around 15, 14, 15, but you can see realized volatility is bumping along too, between like 10 and 14. This is 20 unrealized, this is 10. So it's in the same area. So again, nothing is wrong with VIX. It's just representing a non-volatile market. If the market starts to get volatile, bad things start to happen, VIX will increase, and that will be our sell signal. So where do we stand? Summing all this up, we've got a buy signal from the S&P 500 chart. That indicator that I show you, new highs versus new lows, that's been on a buy signal since January. It's still there. The construct of volatility derivatives, we just looked at that. The term structures are all sloping upwards. The breadth oscillators, I kind of straddled that here between bullish and neutral. I just moved back in, to the slightly overbought area, but boy, that, this indicator, I would like to see it way over here, but breadth just hasn't been that good. Now, right now, we don't have a trend of VIX, so there's no signal there. We don't have a McMillan volatility band sell signal. That was the one we're looking for it to go above the +4 sigma, 4 standard deviations. And the VIX spike peak buy signal just expired, so that's not in effect either. Now, the only thing that's even halfway close to a sell signal of our indicators is this bearish, is the equity-only put-call ratio. And as I showed you on those charts, they're technically just starting to slope upwards, but they're really not, in my opinion, strongly on a sell. So again, this is kind of straddling the line between, bearish and neutral. So overall, that's still a modestly bullish pattern. I don't really have any confirmed sell signals. We don't have as many buy signals as we used to. We did have a trend of VIX buy signal. We did have a McMillan volatility band buy signal a ways back. We had a spike peak buy signal. So we've lost some of them, but still, we're holding a core bullish position. And what we typically do is we roll our positions up as they get deeply in the money. So my definition of deeply in the money for a SPY call is about 8 points in the money. So I'm buying it, I'm buying it when it's, say 1 or 2 points in the money. And when it gets 8 points in the money, I'm rolling it. And so we just rolled all of our positions up yesterday and today as S&P was making these big, strong moves. And, we'll trade other signals around that core. I'm not just going to give up the core because some sell signal appears out of nowhere. What was that? We will trade other signals around the core, and then we'll change the core if the S&P chart becomes negative. So I want to finish up with this offer that we're having, and then I want to have one more kind of recommendation. So we're at this website, optionstrategist.com/traders exclusive. You can not only download the PDFs of this webinar, but you can get this offer. So we're offering our top 3 newsletters for 1 month of each of the 3 for a total of $99. Typically that costs $728. So our 3 top newsletters are Daily Volume Alerts, the Daily Strategist, and the Option Strategist. The Option Strategist goes back, by the way, you can take these, if you took them all at once, it might be too much. So you can take them back to back to back if you want to. Just let us know when you subscribe. But the Option Strategist, we're in our 33rd year of publication. It comes out once a week. The full track record's up on the website year by year. And every year we write at least one issue describing how the various strategies broke down for that year. The Daily Strategist comes out twice a day, so that's really our heaviest, most active newsletter. It has the same strategies, a lot of the same strategies as the Option Strategist, but just keeps things up to date more frequently. And then daily volume alerts. That's was originally intended to see where volume was accelerating and try to find takeovers. That doesn't happen too much anymore, although we did have one or two. But it mostly follows all these trading systems I've been talking about. In fact, all of these newsletters follow all the systems I've been talking about. So our daily volume alerts track record has been excellent. This is taken from yesterday's issue. And you can see the realized profits taken to date in the red area, red outlined area, have been quite good. And of course, we, as I said, when we get these buy signals, you can see some of these cases we bought, we've been long for a long time. Our core position here was established last November, and that was right after we had bought a straddle, and then the market broke out to the upside. But this one has been there since January. And so, we've rolled up positions many times since then. That's where these realized profits come from. But for $99, those kind of, and these, I'm not talking that we bought like 20 contracts. We're buying one or two SPY contracts to produce those kinds of numbers. So we also, I have a YouTube channel. We record a market comment every Monday. I invite you to become a subscriber of that. And then we have a couple of other newsletters too, although they're not included in that special. But the daily put writer has been quite successful. That's one of those where you see it advertised, 90% wins. Of course, writing puts 90% of the time you're going to win. It's what you do the other 10% of the time that makes a difference. And we've been pretty successful at avoiding extreme losses, and that has a great track record as well. So the last thing I want to talk about is you may have heard of the strategy called Dogs of the Dow. That's originally was at the end of the year, you look at the worst 6 performing stocks in the Dow, you buy them, you hold them for 1 year. They're paying extra good yields because all Dow stocks are paying decent yields, and those are, stock prices down, so the yield is up. And then at the end of the next year, you sell it and do it all over again. And for a while, that worked really well, but in recent years, hasn't worked all that well. But this is a different version. So recently, the Dow dropped Walgreens. And I wondered just, what happens to a stock once it's out of the Dow? So since 2015, I believe 7 stocks have been dropped by the Dow and replaced with other stocks. And we wrote an article going into more detail, but I'm just going to show you the charts here. So this was AT&T. It was dropped in March of 2015. You can see that it had an immediate little rally, kind of went sideways for a while, and then really took off. But it really never went much lower. Here's where it was dropped right there. Never really went much lower. So if you'd have bought it there, it's just a matter of holding it long enough to come out all right. This is Exxon. This one did go a little bit lower, but then turned into a short-term gainer, and then obviously a much bigger long-term gainer. So again, that was from August of 2020. This was Raytheon, changed its symbol. Again, this one dropped a little bit over the next couple of months, but then exploded to the upside and really took off. This is Pfizer. I don't know why the Dow dropped that. That's right in the middle of the pandemic. I mean, everybody knew Pfizer was working on a vaccine. I don't know why they would drop it from the Dow, but they did. And it jumped up when the government said Pfizer was one of the 5 chosen ones they would help fund the vaccine. And then later on really took off on the vaccine. That's fallen back since, but, whatever, still worth buying it the day it was dropped. Doesn't work every time, though. Here's 2 that it didn't work on. This is Dow. And you can see that it tried to rally immediately and then fell back to new lows. and stayed there. So that that one you would have lost on, and this one also GE. Now GE is way back up now, but from there it wasn't. But still, 5 out of 7, I would say it worked pretty well. So here's Walgreen. This is why they dropped it. You can see it's pretty much a dog, and they dropped it. So we're just waiting and trying to see if it can close back above this little area right here. Then we're going to buy. We're going to buy some longer term calls, some 3 to 6 month calls, and just see what happens. So you might just keep that in your notepad there, see if it occurs. So I invite you to visit our website. It's a brand new website. We've revamped a lot of issues on the site, and here's all the contact information. If you're interested in our money management, this URL at the bottom here is where you can go to get to sign up to get data on that. I will say that our managed accounts are $100,000 minimum, so just keep that in mind. All right, so Sherry, let me turn it back to you. I don't know if there are any questions or not, but I'm pretty much done. Is Sherry here? Let's see if I can find the questions. I don't see them. Well, if you have some questions, I guess type them in that chat area. Would probably be the best thing. It says we'll begin shortly. That's not really true.
Sorry, Larry. I thought I unmuted myself, but then I look over, I'm muted again. I'm sorry. Mike asked, do you ever do diagonals or calendars for events?
Yes, and we did a lot of that for quite a while. We had a very, I thought, successful earnings strategy. But the market's very efficient, and so when a strategy works on a theoretical basis, the computers will pick that up, the ARMs will pick that up, and it will go away. So we haven't been doing too much of it lately, but we definitely did in the past, and I'm always taking a look at those things as well. Really, I don't know why exactly, but the whole post-pandemic market really messed up the earnings strategies that I was using. We used to look for where this post earnings strategy straddle price had been exceeded by quite often by previous earnings moves. That doesn't seem to happen anymore. They pumped up the prices on these pre earnings straddles pretty heavily. So I wouldn't say we don't ever do it, but we haven't been doing a lot recently.
Okay. And then let's see, Tom would like to know, where do you get the breadth data?
So New York Stock Exchange data you just get off the website. The other one we calculate ourselves, obviously all optionable stocks, and we post that in all 3 of those newsletters in every edition. So daily it comes out in the Daily Strategist or Daily Volume Alerts. The stocks only advances declines is posted there. To calculate it yourself would be pretty tedious. You'd have to know all the optionable stocks, but we put it out, the morning of the next day in all of our newsletters.